Welcome to Learn Accounting Podcast by Professor Accounting. This is episode 9, Accounting for Depreciation and Overview. This is an overview for any student obviously doing A-level accounting. It will be useful as well for students doing business studies and to some extent economics. It will be GCSE business studies as well as A-level. It will go through some of the basics first. So it's depreciation of fixed assets, which is also termed non-current assets. Let's start off with a very basic example. Best way I think of starting this topic is to choose an asset that quite a lot of students are familiar with. So I've gone with a very well-known brand mobile phone here, and if you have one of these, if you own one of these, then that is your asset. So let's take a little example of how much these would cost. So I've just started with some basic numbers. Hopefully they do relate to the actual product. Let's say if you're buying this product, it costs £500. Presume pay-as-you-go maybe might be £500 as under contract, somewhere a little bit less. Let's look at the suggest a value after year 1. So I've just gone for 450. Value after year 2, something around 400. Value after year 3, 350, and the value after year 4, £300. So if we think about the amount of depreciation that's incurred each year, we need to look at what depreciation is as well. But if you think about going from cost, what's the value after year 1? Well, it's reduced. So that difference between cost and then new value over a period is termed depreciation. So it's the loss of value. So each time year 1 is £50. Again, we take off a bit of the asset if you wish. So in terms of the display, the phone, you could look at the whole phone as total cost, and if you're depreciating, then you're losing some value. Second year is £50 as well, so you lose a chunk, and the chunk of that is the same amount, obviously because it's £50 each year. It's year 3, year 4, and then lastly we need to think about that proportion has obviously been depreciated. What's left? I could continue, so let's kind of suppose think about how many more years would it take to depreciate. So count them up as we go through. There's 1, there's 2, there's 3, there's 4, there's 5, and lastly there's 6. So equal amounts as the previous years, or the chunks of the phone, so it's an extra 6 years. So if we continue taking away £50 for another 6 years, then we would reach eventually would reach 0. So the phone is worthless. So there's no phone left, so the phone is worthless. So it's 6 years it would take extra, so it's a total of 10 years. So what method is this called? So basic illustration, this method is termed the straight line method, and it doesn't indicate why on the calculations. So best way of understanding the reason why they term straight line, you do need to know straight line. Basically it's because of a graph. So I've drawn a graph here, and this graph is representing the amount of depreciation, and if you look at the bottom, the x-axis, it goes from year 0, which isn't labelled, but year 0, which is the origin, year 1 to year 10, and basically there you can see the amount of depreciation each year is £50. So the line, the linear line, is represented there, so it's a straight line. Now that is, I suppose, part of the reason why we call this straight line, because the same amount of depreciation is applied each year, and it represents a straight line, a horizontal line. So that's part of the reason. If you look at another graph, another representation, we could, instead of looking at the depreciation, we could now look at a different perspective, which is the asset value. So if you look at, again, this one I've got year 0 on. So year 0, the asset starts at £500, and we can see that obviously from the graph. Year 1, it's the lower, it's 450. So the values I've used. So by the time you get to year 10, it's reached 0. So if you then do a line of best fit, it's a nice straight line going from top to bottom. So that is a straight line as well. So either way you represent the data, you will always get a straight line. So that is why this method, whichever way you look at the data, is called straight line method. Okay, so how do we calculate this method? So in an examination, you would obviously apply the calculation there by using the same amount of depreciation each year. That's the trick. But how do we use this in a different way? So there is a formula that we obviously need to know. definitely for accounting students in AS, sometimes in A2, depending on if they bring in some area of the AS syllabus. So the formula for using straight line here, a few ways of doing it, or different terms. We take the cost and we minus a scrap value. So we've not done scrap values yet. Scrap value could either be different terms for scrap value. Words could be disposal value, or it could also be residual value. So depending on the exam board uses different terms, but they mean the same thing. We divide it by the number of years. So cost minus scrap value divided by number of years. So if we take our phone example, cost was £500. I never gave any indication of a scrap value, so it's 0. And the number of years, well, it was actually 10 years it took. So if we work in this way, we would get an answer of £50 for each year. So this method, what it works out, your answer you get all the time when you work this method, is you're actually finding the amount of depreciation for each year. And because it's straight line, you know the answer, £50, will be the same for each year. Scrap value there is, again, just to mention, you would be told in an exam question, but what does it mean? £0 in this case, well, it's not that you don't have a scrap value, it's just the scrap value is 0. That means that if you have a scrap value of 0, it means that the business is going to keep the asset until it's worthless. But if there is a scrap value known, maybe, like for example, let's say £100, that means that when the value, the worth of the asset becomes £100, that's the time when the business will dispose of the asset, which means selling the asset. So when you, if you put £100 into this equation instead of the 0, obviously your answer, you would get a different amount of depreciation, because we only depreciate for the assets we have when we own them. If we're going to sell it when it's £100, obviously we're not going to depreciate after we've sold it. So we'll come on to that one in probably another podcast. It's a bit more difficult, but that's the formula for straight line method. Let's look at briefly just the reasons for assets lose value. So why particular fixed assets, and we'll look at stock here. Stock is an asset, but we're looking at fixed assets because we don't depreciate stock, we depreciate fixed assets. So a little, rather than just a list, I wanted to give you some pictures. So reasons for assets, fixed assets losing value. So let's just define the words. Fixed, in this case, is now called non-current assets, but fixed means, it's a nice term to use because it explains it quite clearly. Assets that are likely to be with the business for a long period of time, a fixed amount of time. It doesn't mean that you can't sell them, obviously they can, but it's obviously going to be in the business for longer than stock. Just some examples. We've got land, we've got buildings, premises, machine equipment. Land being an interesting example. Maybe some of you have spotted it. Land is certainly a fixed asset that rarely depreciates. It actually typically appreciates, which goes up in value. But buildings, premises, machinery, equipment tend to depreciate. Let's look at some reasons then. Here's an EPOS system, so it's some form of advanced tilling system in a retail outlet. So this is the more modern version compared to maybe something that obviously was used, still used today to an extent, but certainly something that is less functional. So new models of versions become available, so product is in less demand. So this top picture being the product that is in less demand, so that product will typically lose more value. We would need depreciating more value over a period of time compared to the other model, the newer model. Second, let's look at some touchscreen TVs compared to a very old Apple computer. So in terms of depreciating here, basic technology changes. So the more that technology changes, I think this Apple Mac was taking floppy disks, or maybe from the picture it was the old style hard disks rather than what we have now with USBs and using the internet and so on. So changes the technology. That again is a reason why we have to depreciate. If people aren't buying products, then certainly this product on the screen now, the Apple computer, is not worth what it originally was being sold by the retailer, so it would have to be depreciated, maybe by a significant amount. We've got the typewriter as well, which obviously is even more older style, maybe still used today in some cases, but certainly you've got an example there of assets or a product may no longer be needed by a customer or a business. So I suppose businesses won't need to use this typewriter, and certainly customers may not want to buy it because they can obviously buy a more up-to-date PC. So the term here is called obsolescence, which means this product is obsolete, it's no longer needed. Next one, the picture, it's basically here. You might see some of these before. It's accounting concepts. So the reason we depreciate also is to follow the rules of accounting concepts, and there's a variety we'll look at it in another podcast. Let's get a second method. So the first method, I remind you, was the straight line method. Let's now look at the reducing balance method. I'm going to use the same example with the mobile phone. I'm going to use a rate of 70%, rather high rate, I will admit, but you'll see why I've chose 70%. Typically you'd use 30 to 40 in questions, but it doesn't matter, it's the same approach, doesn't matter what percentage you have, but maybe you'll see why I've used 70% in a moment. Method used for fixed assets such as motor vehicles and equipment. So they're the examples that reducing balance is appropriate for, typically because they lose a lot of value during the early stages of their life. So we'll come on to that in another podcast. So let's go back to the phone using reducing balance. So the cost again is £500. So we said 70%, didn't we? 70% of is the depreciation rate. So the method here, we find, working for depreciation year 1, we find cost, and we take away the any existing depreciation. So the rule in reducing balance is, with reducing balance you need what's called the net book value. Now the interesting bit about this method is in year 1, when you're finding the first year's depreciation, well, there's no existing depreciation. So when you're working this one out, you don't have to write this, it's just to explain it. There's no existing depreciation, so there's nothing to take away from the cost. So cost minus 0 times 70%. So we get an answer there of £350, and this is the balance net book value, which you'll see is £150. So cost minus net book value gives you £150, which you see there. So it's quite a big reduction in year 1. Let's look at year 2. So year 2, now this is where things, again, students need to apply the same method again. This is why I wrote the first one the way I did. So in year 2, what are we going to find 70% of? Is it 70% of £500 or a different number? Well, it's 70% of the net book value from the previous year. So it's going to be 70% in this case of net book value, and net book value in this case for year 2, reducing balance method for year 1. So it's £150 we've arrived at from the end of year 1 times 70%, and that gives us £105, which is the depreciation, which is taken away from the net book value, and that gives us £45 left as the net book value at the end of year 2. So again there, that's only 2 years, so it's gone from £500 now to £45, but that's because I've used 70%. Now the reason I've done this, obviously, if you can just decide to, you try now yourself, I'm going to continue, but you try yourself now to use that example and continue the same method. So now do 70% of the net book value at the end of year 2, find the depreciation for year 3, and then find the net book value at the end of year 3, and so on, up to year 10. So it's a bit of a task, and try and see what's happening. Okay, so maybe pause the video now and try and do that, and then just come back and watch the rest of the video. Here is the answer. So we got up to the end of year 2, and we got net book value of £45. So then you can see there depreciation year 3 is £31.50. Net book value at the end of year 3 is £13.50. So it's going down, 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 and just look down the whole list. What's happening as we go down the list? Eventually we get to year 10, and in year 10 depreciation is a penny, and the net book value is 0. So it's getting very small. The point is, why have I done this? Is to illustrate the first of all, the nature of this method. It's because it's reducing balance, you're finding a percentage of very small values eventually, so it becomes incredibly difficult to eventually get to 0, or it takes a lot of time to get to exactly 0. And I use this 70% just to prove that you need a high percentage to get to 0, because we have to get to 0 because there's no scrap value. We're going to depreciate the full £500. So this phone, using this method and using this percentage, is going to lose £500, which is the full cost over a 10-year period. So you can now start to compare this method with the straight line method as well. this is the graphical representation of the amount of depreciation each year using this method. So why have I done this? Well, remember I did it for the first method, the straight line, and if you remember, because it's straight line, it's an equal amount. So with straight line is an equal amount of depreciation each year. This method is very different, isn't it? From looking at the chart, year one, no matter what method, no matter what percentage you use, is still going to give you some form of representation like this. There is a significant amount of depreciation incurring during the early stages. Now there is a lot in year one in this example. Year two, there's still quite a bit. Year three, still quite a bit. Eventually in year 4, 5, 6 and so on, it eventually flatlines and gets to 0. So this kind of method, if you draw a line in this, economic students, so our business studies students, you're getting some form of curve, aren't you? If you draw a line of not a horizontal line or a straight line, but if you use some form of curve line, you can see that it's diminishing, and it obviously touches the x-axis eventually to 0. So a different perspective, a different illustration of depreciation. Now net book value at the end of each year, do it for this method as well. It actually looks very similar, doesn't it? It looks very similar in terms of the worth. So net book value, remember, is cost minus all depreciation to date, which is accumulated depreciation, and that gives you obviously a similar graph in this case. A task for you. So I'm going to leave you with this task to think about. Those of you who see this podcast, why don't you try it? I'm going to do some different questions, different examples. This is the one I tend to do with I've done in the past with some students. Just run through with you. You buy a new vehicle for £2,000 and you depreciate it every year using the reducing balance method, and the rate is 35%. Your friend has done some calculations and presented them to you in a table. Okay, so choose a friend, someone who's doing accounting with you, and this is the information they give you. Now, clearly from the information, the task is, as it is in red, it says spot the mistakes made and find the correct net book value at the end of, I put year 5. I know year 5 isn't on there, but I'll show you a pro forma in a moment. So I want you to find mistakes, basically. What's wrong with it? So if you go through this podcast and go through the points that I've raised in terms of the key features of this method compared to straight line, you're looking for kind of specific criteria or specific factors that relate to each method. So this is reducing balance method, remind you of. So maybe look at some maybe obvious errors. I'll show you. There's only 3 errors that I've put into this. So here's an answer sheet. So reproduce the grid or do however you want, but this is how I would give to students. And I want you to reproduce the values in a grid and list the errors that you found. I'll obviously show you a solution as well at some point, maybe in a few days or so, and depending on how many students have viewed this podcast. If you want to comment on the podcast with some answers or some questions, feel free to do so. That'll help other people, and obviously share your ideas as to what you think the errors are. So this has just been an introduction to the topic of depreciation, and I hopefully you found it useful. And here's my contact details, and I want to thank you for stopping by, and I'll see you next time for another podcast from Professor Accounting.